One of the questions we get a lot, and have already done some video blogs on, are why haven't capitalization rates gone up faster relative to the interest rate rise? And my partner and I have blogged on it, and we've done some videos on it. But I thought it might make sense to go over the equation of perpetuity because it relates directly to what's happening in the markets and why not only have cap rates not gone up in many of the asset classes, but also why some of the cap rates have gone up and down relative to different asset classes, and I'll explain. But the equation for a perpetuity, and what I mean by that is anytime you're looking at an asset, you're looking at the potential cash flows from an asset over time, but then the potential terminal value of that asset, and all of the cash flow streams are discounted back by what we just went over in another video blog called the discount rate, or the required return on equity, or the WACC. So all those things are terms that are thrown around a lot, and you can refer to what I just went over if you have interest in that. But let's just talk about an asset that we're pricing, and let's say that we plan to hold this asset for 5 years and then sell the asset, and the asset is providing cash flow in every year. And so I would just simply have a year 1, a year 2, etc. Year 3, year 4, year 5. So I'll just do this. That's 4. That's 3. That's 4. We'll do here 4, and I'll do 5. And then in year 5, there's also a perpetuity equation. And the reason there's a perpetuity equation is just because I'm selling the asset in year 5 doesn't mean that the asset doesn't still have cash flow, doesn't still have value. That's why the next buyer is buying it, because they believe that probably that not only is there value, but they can enhance the value beyond what I had already done at origin, right? So in terms of cash flow that comes out, let's just define that as NOI, net operating income. In the public markets, it's defined as EBIT or EBITDA. Same idea, but there's an NOI X or an EBITDA X that's generated in year 1, and it's divided by the WACC, or some discount rate, right? In the first year, it's just divided by the discount rate. In the second year, it's divided by the discount rate, so the WACC divided by the discount rate. However, since it's in year 2, it's going to be NOI divided by discount rate to the second power. And this is just discount rate formulas. It's used in every financial model, whether it's M&A, LBOs, real estate, private equity, doesn't matter. In year 3, it's NOI divided by discount rate to the third. And you can do this in Excel. You're dividing cash flow streams by a required capital return into the future. As you can imagine, in this year, it'd be divided by the discount rate to the fourth, right? And where it gets interesting, obviously in the 5th year, your cash flows are divided by NOI divided by discount rate to the 5th. But you're also, in addition to NOI divided by discount rate to the 5th, plus P, which is a perpetuity. And the perpetuity is also discounted back. I just threw something at you. But the discount rate is it's just another cash flow that comes back to the company in the sale year, right? However, let's do it. So the perpetuity, what I'm doing now is I'm actually pricing, using a formula, what I believe the market will value this asset at going into the future, okay? So a perpetuity formula, I'll just call it perpetuity, P. In the real estate world, again, I'm going to use NOI, but it also can be EBITDA, it can be EBIT, it can be whatever your domain group defines as operating income. But the difference is you're multiplying NOI, 1 plus G, where G is growth, and you're dividing it by WACC, there's WACC again, shows up again, minus growth. Now, G is a really interesting variable that's thrown in, and it also distills down all of the things that you see as capitalization rates back to real estate, why they move, right? So, if I have an NOI of $1 million in my terminal year 5, I'm multiplying $1 million, 1 plus G. Now what's G? Growth is my growth rate in earnings, or my expectation of growth rate in earnings in that asset class or in that asset specific. So let's say that in this case, I think it's 5%. I think that we can continue to grow earnings, and more importantly, the market thinks that. So what I get is not $1 million. I get, remember, it's NOI times 1 plus G, right? So I get $1 million plus another 5%, right? So I get $1,050,000 here, because that's 1 plus G. More importantly, whatever my WACC is, let's say that my WACC is 10%, defined as the total cost of debt times the multiplication of debt, that rate, and the total cost of equity times that required return on equity. And let's say it's 10%. That's what I came up with. 10% minus G, where G is 5, equals 5. What I'm solving for here is a multiple on earnings, right? Because if I divide this number, right, 10% by 5%, so if you divide this by 0.05, it's the same as having a 20 multiplier. That's what dividing by 5 means. So my total perpetuity isn't $1 million anymore. It's actually $1,050,000, but let's just make it very simple. If it was $1 million, your total perpetuity is $20 million. $1 million times 20. And in fact, in this case, it's $1,050,000 times 20. So it's actually $21 million, right? So that's your answer. You have a $21 million asset. And as you can tell, the biggest driver and what created this value was the expectation of growth. It not only increased my numerator, but more importantly, it took my denominator, which this is a 10 multiple. So I'd have a $10 million asset, but when I subtract G, this is a 20 multiplier. That's where the real value is created. Now, let's get out of the world of, and by the way, this is also a cap rate. Your denominator is a cap rate, and that should make sense because your cap rate is also the formula for perpetuity in the sense that if the expectation for growth is very high within an asset class or an asset itself, the cap rate will always be much, much lower than if you believe the income or the growth rate of that income has been maximized today. Why are you going to pay a big multiple on that? It's already been maximized. So let's take this to the extreme because you see this today when I say that capitalization rates haven't gone up. That's a general statement across all asset classes of real estate. But let's pick a few. Retail, industrial, multi. Okay? If you were a retail investor, either you're a retail REIT, you're an investor in a retail REIT, you're a private equity firm that focuses on retail, and I told you tax reform hasn't done anything to cap rates, if anything they're the same or lower, you wouldn't agree because you've seen that they've gone up. If you were an industrial REIT CEO, investor, or private equity manager, et cetera, or just a personal investor, someone who's managing their own money, you would say not only has tax reform not resulted in higher capitalization rates, they're lower. And if you were in multi, you would say, yeah, that's kind of true. They're about where they were. Nothing much has happened. But the reality is all of these things are true. These have gone up. These have gone down. Not much here. But the main driver is the expectation of G, growth. The expectation of growth, just as you saw in the formula for perpetuity, right? Because it's NOI times 1 plus G, WACC minus G. It can't be any more clear than that. If your expectation for growth in retail is low because Amazon's disrupting everything and retailers are going out of business, and not only are they going out of business, but it's going to get worse, not better, because online sales are the highest growth rate of any sales. So it's bad getting worse. When you do your perpetuity formula, your G might be negative. Think about that. Think about having $1 million of NOI, but you say, you know what? Not only is there not growth, it's negative growth, which, by the way, is absolutely possible. Think about all the industries where, heck, I might buy them. I might buy buildings that have negative growth, but I have to buy them at such a high cap rate that it makes sense, because I'm going to get all the return I need in years 1 through 7, because I know it's a race to nowhere, right? That's why these capitalization rates are going up. It has nothing to do, or much less to do, with macro events around interest rates. It's actually idiosyncratic to your asset class, the way the market views you. So the same thing is true in industrial, and the same formula applies in the inverse. So if you're not in bricks and mortar selling retail products, you're Amazon, but boy, do you need distribution centers. And you need them regionally, and you need them infill, and you need last point distribution. And so all of these assets have a very positive growth characteristic. And so you see a growth rate that is presumed by the market and manifests itself in capitalization rates. But the reality is this is what's happening. It's a formulaic process that the market plays out thousands and thousands of times through transactions. This growth rate in industrial continues to go higher, and so the cap rate continues to press lower. None of that is the result of tax reform or interest rates going up. And then multi kind of hasn't moved. Why is that? Well, my opinion could be, well, at the end of the day, multi, no matter what happens in the disruption of how we buy and consume products, or even how we work, right? So maybe we don't work as much in office buildings. You can make that argument, and that affects the G of office. But in multi, people need a place to live, and I don't really see that changing. And guess what? Neither does the market. And so it really hasn't moved much, right? So we've had tax reform. The borrowing rates really haven't gone up, even though the risk-free rate did go up, but the spreads, and I talked about this in one of my other video blogs, but the spreads that lenders demand to take risk have come in. So me as a borrower, that hasn't really moved. So my total WACC hasn't really moved. And in terms of multi, expectations of growth haven't really moved. So guess what? Capitalization rates haven't really moved, and neither has the formula for perpetuity. And this is how all of these things interrelate. There is a process and a methodology even within real estate, but I'll tell you that this formula and the idea of discounting back cash flows is how you come up with a valuation in any asset in any industry.